In this episode of What's Working Now, we will talk about how the rich hide their money and pay no tax. Do you believe me? If I told you that Warren Buffett pays less tax than his secretary, you might wonder how a billionaire can pay less than an average earning secretary. The answer is that there are two kinds of billionaires. Some taxpayers accept taxes as a natural part of life and pay whatever the government demands, and some do everything in their power to avoid paying taxes. Let's call each of these people Paul and Jack. When the government comes knocking at the end of the year, Paul doesn't see it as a big deal. Earning $40,000 a year, Paul hands over his $15,000 in income taxes and moves on with his life. Sure, he would like to keep more of the $15,000, but he sees paying taxes as a normal part of life. Jack, on the other hand, is a medium-sized business owner. In his search for tax strategies, Jack investigated ways to reduce the amount of corporate tax his company pays in his tax bill. Jack discovered the following techniques. Method number 1 is to write off expenses. Because most wealthy people make their fortunes through business, they can write off expenses and taxable income. You see, most expenses you incur in your day-to-day business operations can be written off against your income to lower your taxes payable. For example, if you run a digital marketing agency and make $200,000 yearly with no expenses, the entire $200,000 would be taxed. Rents and leases, employee benefits, staff training, car expenses, for example. As the company owner, if you decide to go to a conference to improve your digital marketing skills, you can also write that off. This method of lowering your taxes is only available to people who own businesses, which explains why most people who own businesses appear to be significantly wealthier than people who work as employees. Method number 2, diverting income. As of 2017, the United States corporate income tax rate was reduced from 35% to 20%, and while this provided many companies, including Amazon, with the opportunity to significantly reduce their income tax payable, many companies still elect to recognize their income in countries with even lower tax rates, such as the Cayman Islands, which has no income tax. No corporate tax, estate or inheritance tax, gift tax, or capital gains tax, making it a pure tax haven. Of course, without any calculations, it is obvious that this is a significant saving to any business that can realize its income overseas, but how much would this save you if you had set up a tax haven in this country? Say your business earned $5 million last year instead of paying an income tax on this. The Cayman Islands have very strict banking laws designed to protect banking privacy. The country does not have any tax treaties with other nations, shielding the finances of its offshore banking clients from the tax authorities of other countries. Furthermore, offshore corporations in the Cayman Islands are not required to submit financial reports to any Cayman government authority. It's no surprise that businesses are flocking to these remote locations to conceal their earnings using Method 3, netting revenues against losses. If you've looked at the statistics in favor of starting a business, you know how depressing they can be. According to the statistics, 20% of small businesses fail in their first year, 30% fail in their second year, 50% fail after 5 years, and 70% fail in their 10th year in business. Even though the chances of business success are rather low, numerous companies still succeed and make a fortune, which they need to protect, and one way they do this is through the use of losers. Most businesses require a few years of operation before they begin to turn a profit, and in years when business is not exactly booming, losses are unavoidable. While these losses were unfortunate at the time, they are excellent tax avoidance tools for future periods because expenses loss carryforwards can be netted against your earnings to reduce your overall taxes payable, which means that less of your income is subject to tax. Method number 4, issuing stochastic. Another way for businesses to reduce their taxes is to issue stock options to their shareholders. This method is particularly convenient for businesses for two reasons. First, it is recorded as an expense, reducing profits and, ultimately, the amount of money subject to tax, and second, it does not result in a cash outflow for the business. When issued, stocks are recorded as an expense for accounting purposes, but no cash changes hands. As a result, the company can reduce profits through expenses while maintaining a strong cash position. Furthermore, companies that use this strategy reap the benefits by incentivizing their shareholders to increase the stock price further. If you own stock in the company you work for, wouldn't you go above and beyond to increase the company's stock value so that you can cash out your options for more money? As a result, Jack is becoming more confident that he can reduce or eliminate his corporate tax bill. Still, he also knows that he needs to withdraw some income from his business to live and that cash should be taxed as little as possible, so he decides to switch gears and consider reducing his tax owing. Method number 5, leveraging geographical tax laws. For the past 20 years, Jack has grown his business in the heart of Silicon Valley, But his patience with living in while federal taxes cannot be avoided, Jack sees a large portion of his income being passed along to his state government, with even more being passed along at the federal level. Jack wonders how he can avoid the other taxes eroding his wealth. Jack began researching other states with lower income tax rates and was surprised to learn that 7 states, including Texas, Nevada, and Florida, were income tax-free, which meant he could save the 13.3% tax he was currently paying while still enjoying the warmth of the sun all year. As Jack began looking into housing options in these 3 states, he wondered if there were other ways to reduce his tax bill further. You are investing in real estate. Because one of the reasons the rich continue to get richer is that they make their money work for them, and one way they do this is through real estate. You see, not only does owning real estate increase your wealth by generating income, but it also allows for a reduction in taxes payable. When you buy a property, you require a depreciable asset. Because the asset decreases in value over time from an accounting standpoint, you can deduct repairs to the property and mortgage interest are common deductible expenses. Because you require the more money you spend on expenses, the more you can reduce your tax bill. However, once a property is fully depreciated, what do? You sell that property and buy a new one, while selling property usually triggers taxation. There is such a thing as a 1031 exchange, which allows you to defer the tax you paid on selling the property if you buy a new property within 60 days of the sale. In essence, you can continue to depreciate your properties and then sell them in perpetuity and never pay the tax while still being able to use the assets to generate rental income. He still believes that some of his income should be taxed, and another way he can do this is by deferring his income. The most common tax deferral vehicle is an individual retirement account, IRA, which allows you to move your income into a fund and subject your earnings to tax later. If you're an employee, you probably use this type of account to hold your savings and allow them to grow over time, but it also doubles as a solid tax shelter. You can do just that with an IRA because when you contribute to your IRA, you don't pay any tax in the year you contribute and instead pay tax when you withdraw all of the funds, typically during retirement. However, during retirement, you'll most likely be earning much less than $500,000, so the money you withdraw will be taxed at a lower rate, and the difference in tax rates is how much you would have saved by using this income deferral technique. Thank you so much for watching. If you like this video or think it would benefit a friend or someone else, please share it. Also, guys, please do me a favor and click on the bell icon and enable notifications if you're a subscriber. If you're not, well, welcome to the channel, and I hope you subscribe and enable notifications. With that said, thanks for watching, and I'll see you at the next one.